Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting, and our topic today is property, plant, and equipment non-cash acquisition. Notes payable. What is it? Companies can also acquire assets without paying cash. So we can eat by deferred payments, our notes payable. So let's go to our Excel file and double check how we do it. Our Excel files, they are free, and the link to download it is in our video description. So what do we have here? On January 2nd, 2020, the Scarping Corporation purchased industrial equipment. In payment, Scarping signed a non-interest bearing note requiring $450,000 to be paid 2 years later on December 31st, 2021. And okay, we have a problem here. Notes payable will be 450. That's okay. However, this is the future value. This is the value that I will pay it in 2 years. It's not the value now. And if we will pay it in a period more than 1 year, if this notes payable is a non-current liability or long-term liability, depending on where you are, then we need to bring this number to present value. If you have questions about present value, we have a video about that, and the video is in our video description. Okay? So how do we do that? Formulas, insert function here, present value. Rates. So if Scarpin had borrowed cash to buy the equipment, the bank would have required an interest rate of 12%. We have two ways to do that. The first one is this one. How much would be my interest rate if I go to the bank and have some money to buy it? Or how much is the cash price of this equipment? That is our second sheet here. Okay, so wait 5 minutes. So our rate 12%. Number of periods 2. PMT, our monthly payments or annual payments, nothing. Future value, our payment at the end of our contract, negative for 50. Why negative? Because present value and future value, they have opposite signs. So I want a positive number for my equipment. So we have here the negative for future value. 358 discount on notes payable. How much is it? The number to balance our journal entry, 91. Okay. On 2020, we have no payments. However, we need to accrue our interest expense. You can do it just like I'm doing here, annually or quarterly or monthly. That depends on you and your country legislation. Okay? But usually we do it annually, or if we are a public company, we do it quarterly because SEC requires it for uh, financial statement publication. Okay, so interest expense, how do we find it? It's our equipment times our interest rate. Because the equipment is our carrying value. And here, we are working here just like an amortization schedule. And if you have questions about amortization schedule, check our channel. We also have a video about amortization schedule, and it is in our video description. And the debit is, or the credit is discount on notes payable. And here, at the end of the second year, our interest expense must be the same as our discount on notes payable, and the discount on notes payable must be closed. Because if we don't have notes payable, we don't have discount on notes payable either. So we have two journal entries here that we can combine in one, as we are doing here, or two separate journal entries. First one, we are paying our notes payable and cash. Oh. So notes payable, we close it. The second one, the interest expense and discount on notes payable. So discount on notes payable will be the same as our interest expense. How do we find it? Our carrying value, equipment plus interest expense times 12%, 48. If you have more than 2 years, it's strongly recommended that you create an amortization schedule. Okay? And as I told you, we have a video about amortization schedule. Discount on notes payable. Close it. So we are good here. And what if we have cash prices here? So let me double check if I can copy and paste all of these formulas here. Yes, we can. Okay, we fix it later. Okay, we have the same numbers. However, Scarping is not sure what interest rate appropriately reflects the time value of money. We quote it in 5 banks and we have 5 different interest expenses. So, okay, that is not a good method. However, price list indicates the equipment could have been purchased for a cash price of $400,000. So our equipment will be $400,000. And so the discount will be our difference, $50,000. However, how much is the interest expense? So the first one is not 358 anymore. It is $400,000. However, it's not 12% anymore, but we don't know it. How do we do that? Some companies, they do it based on a flat rate, just like a straight depreciation based on straight line method. So, okay, 50,000, 2 years, 25,000 per year. However, this is not the most accurate one because we pay usually more interest at the beginning of our amortization schedule and less interest at the end. So, okay, amortization schedule again, but we need the interest rate. Man, if we have present value 400, future value 450, and the period, we can find our interest rate. How do we do that? We go on formula, insert function, let's go with all, and we need to find our rate. Rate here. Okay, number of period, 2 years. PMT, we will not be paying anything until the end of our contract. Remember, present value, 400. Future value, negative 450. If we do the opposite, we have here 0.0060, blah, blah, blah. Let's try to do the opposite. Whoops. Negative present value, positive future value, we would have the same. However, the most common one is positive present value, negative future value. Why? And we can think it. We are receiving the money now, we are paying the money later. So our rate will be 6.07. So the interest expense will be times 6.07. So equipment times our implicit interest rate. 24. We are paying less interest here. And let's do here 400,000 plus 24 to, because we have a discount instead of a premium. Okay, so we are paying less interest now because the next year we are combining our equipment plus interest. So we will pay more interest on the second year. So here, 400 plus the interest expense times the implicit interest rate. Exactly the same. Interest expense 50, discount on notes payable closing, notes payable closing. So what is the difference? This is a little bit more complicated because we need to find our implicit interest rate. This is not so common. The most common is the just like if we have borrowed this money. Okay, guys, thank you so much for watching this video. Like it, by the way, and subscribe our channel. You will be the first one to know when a new video arrives. Also, like our Facebook page, Accounting Hub by Dr. Scarping. If you have questions or comments, leave it here or email me at scarping@gmail.com. Have a very nice day and God bless you.